The world has always been a stage for chaos and opportunity, a paradoxical theater in which the collapse of one economy quietly enriches another. And nowhere is this more visible than during financial crises, moments when ordinary people lose jobs, homes, and savings, markets tumble, and banks fail. Yet amid this turmoil, the wealthy, informed, and patient emerge not only unscathed, but often richer, exploiting opportunities invisible to those blinded by fear and panic, a pattern repeated throughout history from the Great Depression of 1929 to the 2008 financial crash and the 2020 pandemic-induced market collapse, revealing a stark truth. Crises do not create inequality, they amplify it, exposing systemic structures that allow those with capital, information, and foresight to consolidate wealth while the majority struggles to survive. And this begins with liquidity, the cash to act decisively while others freeze, as during the Great Depression, when banks failed, savings vanished, and unemployment soared. Yet a handful of investors acquired undervalued stocks at pennies on the dollar and patiently waited for recovery, generating extraordinary wealth, illustrating the first principle. Those holding capital when assets are discounted gain unprecedented advantage, but liquidity alone is insufficient without information, knowledge of which assets will survive, which industries will rebound, and which companies are over-leveraged. Insights often inaccessible to ordinary people, separating the wealthy from the rest, as in 2008, when hedge fund managers and private equity investors anticipated the housing collapse while millions of homeowners panicked, creating cheap real estate for those prepared to invest, showing that crises are less about luck and more about preparation, foresight, and strategy. And timing is critical because entering too early or too late can turn opportunity into ruin, whereas those with resources and patience act with precision, converting volatility into advantage. And this explains why crises are paradoxically periods of greatest potential for the prepared, yet deepest loss for the unprepared, a duality seen in the panic of 1873, the dot-com bubble of 2000, and the 2020 pandemic, revealing that while the public suffers, the elite benefit, not by chance, but because the system favors those with capital, access to credit, and foresight, where bailouts, stimulus, and quantitative easing disproportionately reward asset holders, while ordinary citizens bear costs through inflation, unemployment, and diminished purchasing power, amplified by leverage, the ability to borrow cheaply and invest in temporarily devalued assets, turning modest capital into extraordinary returns, consistently employed by hedge funds, private equity firms, and corporations during crises, while those without credit remain immobilized, trapped in cycles of vulnerability, and the ripple effects extend beyond individual gain, shaping society, politics, and economies for generations. As small businesses fail, large corporations consolidate, monopolies expand, and power centralizes, reinforcing inequality. Yet crises also create opportunities for those willing to act strategically, to perceive systemic advantage rather than panic, because the wealthy do not merely survive, they adapt, invest, and expand, leveraging distressed assets, undervalued equities, emerging technologies, and market inefficiencies, a pattern visible in modern times, showing that crises are less about randomness than structural opportunity for those with foresight, capital, and patience. And the lesson is clear: crises make the rich richer, not by luck or accident, but by structural design and understanding that design is the first step toward navigating a world where fear, chaos, and opportunity coexist. And the choices we make determine whether we are passive spectators or active participants, ready to act, adapt, and potentially benefit even in turbulent times.